All right. Excuse me. So yeah, double bottom where the second leg is somewhat lower, just like I showed it to you in the chart. I did not make this up. All right. So that's just how it works. So again, the books, the ultimate buy and setup, right? Available to you, right? On Amazon, every single buy and setup that the market will give you, the different variations of it and how to buy it. All right. Very colorful, straight to the point, right? With the price action itself, all different variations for you to learn to truly understand the market itself. And this book, it also gives you a top-down analysis where you mark the zone on the daily and then you drop down to the 4 hour. That way you see exactly how it looks like. And also examples how it looked like on the monthly when you go down to the 4 hour, how it looks like on the weekly for when you go down to the 4 hour. This is everything you need to be successful. All right. You just got to put in just a little bit of time and go through it and understand it. It's just perfect illustration of how the market moves. And you could literally use the same setup in here. Go look for it in the chart. It will be exactly the same thing, regardless of the pair that you trade. Gold, the NASDAQ, the US 30, GBP, JPY, GU, AU, UJ, regardless of the pair. So for metal, indice, and regular pairs. Okay. So, so these are what we're going to cover today. Basically setups, zones, and how it's going to look like with the setups. Okay. All right. So let's go with number one. We're going to go with setup number one. Okay. So setup number one is textbook. All right. We just literally went over it. We got a double bottom, right? With close to an equal low points, meaning it market came to the zone itself. The candle, you see that? It wicked to the zone. Now, when it comes to zone placement, right? They are rules that we need to follow. Okay. Let's go over the rules real quick before we even jump to that. My bad. Right. Zones. Okay. Rules. All right. There are rules you got to follow. Right. There are rules you have to follow when it comes to zone placement. Rule number one. Right. Always. So number one, it's pretty much just two really. Number one, always. Okay. You want to always use the line chart. Okay. All right. Always use the line chart. Okay. The reason why you using the line chart is because the line chart show you exactly where the market stopped and turned around at. So you want to understand exactly where it stopped at. Okay. That's one of the things when it comes to the double bottoms where it seems short, right? But the wick will hit the exact turnaround point. So rule number one, you want to use the line chart because again, the line chart show you exactly where the market truly stopped and turned around, the turnaround point, right? And rule number two, okay, you're just gonna go ahead and put it back on the candles, right? So it will look like this real quick. So it will look like this, right? That's the first zone, okay? You see that? That's just the line, right? And then when you change your chart to the candle format, right? See, that will be the wick of it, right? When you change it to the candle format, you will go ahead and identify that zone, right? Like so. See that? Kind of like that, right? So now I'm going to flip that around for you since we are talking about bottom zones, okay? It's going to be backward, but you know what? Let me not cheat it. Let's just go ahead and knock it out, okay? So let's do a bottom, okay? Market comes, right? It stops and it turns. So we're going to just mark our zone like so using the line chart. That's the exact turnaround point. Now, when you switch it to candle format, it will look like something like this. So the last selling candle will look like something like this, right? See that? That's the body and where it closed at, right? See that? That's the exact turnaround point where it stopped at, right? And then when you turn it back to candles, you will identify the wick, which is the liquidity, where most people put the stop loss, buy limits, sell stops, and all these pennant orders. That's where the money's at within that. So combine the two together, the turnaround point and the wick, that is your zone. So what happened is when it comes to the setups, sometimes it falls deep like so, where it will look like it's a lot lower than the previous low. See how that looks? So just like the setup we just went over, where the last selling candle was down here. Okay. See how it looks a bit lower, right? Well, it's not just, it's a lot lower. And then you did get that bullish engulfing like so, and then it went up, right? And we are currently right now at a double top area that's also matched. That's based off the daily, also 4 hour. See that? Straight to the point. So rule number one, line chart, because you want to see the exact turnaround point. And then rule number two, you go back to using the candles to identify the wick, which is the liquidity. So combined together, that is your zone. Okay. Very simple. All right. So setup number one, we have a double bottom, right? So I'm going to show it to you like just like so. So this is how it will look like with the candles, right? Now with the line chart, it will look something like this, right? Okay. Like this. Let me run it up. Boom. Right. It will look like that. See that? Kind of like this, right? So that will be the turnaround point. Okay. And that will be the wicks. So combined together, right? This is your full zone, right? Now, remember the second setup that we went over where the second leg was somewhat shorter. You notice that? So the close of the last selling candle, let's choose a different, was right here, right? But the wick did tap into the zone itself, but it did went towards the zone. It just did not go all the way in it. So that's how you will mark that zone itself. And then you will wait for your engulfing price action. Okay. Now, of course, you look to the left. Why? Because you want to see what the market did before it bought up. Last time, it gave us a 3 candle price action. What I mean by that is it took 2 bullish candles to engulf the last bearish candle, right? So it took 2 buying candles to engulf the last selling candle to indicate buyers are now in control of the market, right? Now that's just one variation of it. Now, but in this time around, all they needed to do, well, I mean, 1 bullish candle was enough to engulf the previous selling candle. So this is a 1 candle price action where it took 1 candle to engulf the last bearish candle. And of course, you pull trigger. Now, when you pull this trigger, you put your stop loss at the last low. The last low is right here. Okay. And if you choose to put it at the wick, by all means, but this is where I recommend that you place it, due to the fact that if the market does give you a stop hunt, you still be just fine. Okay. But cool, nothing wrong with you putting your stop loss at the wick, but I highly recommend that you use the last low. All right. So make sure you use the line chart and then switch back to the candle. That way you identify the wick and combine the two together. That is your full zone. All right. So let's look at the next one. Huh. All right. Setup number 2. Okay. Now I'm going to generate the zone. You're going to see how much bigger it is. Okay. So this is the last selling candle. That's right here. Okay. That's where it starts at. Okay. Right there. And then this is the wick of it. Okay. Run it straight across. Okay. Notice the difference now. This time around, the market did come into the zone. It sits, it literally inside the zone itself, right? Remember, use the line chart. The line chart will show you the exact turnaround point. It'll show you exactly the last selling candle where it stopped at, where the next bullish candle started off. Now, again, when you identify these zones and the setup itself, you always want to identify the zones as far as, remember, your W's, right? So where highest time frame, monthly, weekly. Okay. When after the market gives you a push up, once it stops, push up. Why? simply because it stopped there. So when and if it comes back, right? When and if, that's the why. When and if the market comes back to the zone, you look to the left and you're going to anticipate for it to do exactly the same thing. You're not saying that it will, right? You will anticipate. I'm not assuming. I will anticipate. Now, when it comes to the price action itself, you always want to use the engulfing bar. Since we're talking about bottom zone, we're talking about the bullish engulfing price action, right? Now, time frame for the bullish engulfing price action is your 4-hour time frame. Okay, so highest time frame, 4 hour for execution, bullish engulfing for price action, and then last low for your stop loss. So here again, single bar price action where you get one bullish candle that was enough to engulf the last bearish candle. Your entry is right here. Your stop loss SL is down there. So we're looking at the last low. Okay, this is literally going to be a rinse and repeat. Rinse and repeat. It's just that I'm going to show you different variation, right? That we literally sink in. My job is to make sure you understand. That way you could just act or react. When you understand, you simply, excuse me, you simply just react. Okay. When you know, you just, that's all you assume because you only know. But when you understand, all you got to do is just act because I understand. Boom. All right. So setup number 2. Right now with setup number 2, the candles look a bit different. What do I mean by that? Right, you get a consolidation where you see 1, 2, 3, 4. Now again, one more time, our setup is based off the highest time frame, the monthly, the weekly, and the daily. All right, I'm going to repeat that. Okay, so this setup itself, you look for it on the monthly, the weekly, and the daily, and then you drop down to your H4 or your 4-hour time frame. Okay, your 4-hour time frame. So you put down when you mark in the zone on the highest time frame, you want to turn on the line chart. Why? Because you want to see the exact turnaround point. In the case of this, you had market consolidating with no wick. So the exact turnaround point will be something like so, right? You see that? I know the line's a little bit crooked, but like so, right? Now, when you put back the candles, right? Because like as you say, there's no wick, but you're still gonna have to use the line chart. But you see there's no wick. So that's just one zone. It's just one line, right? So we place it there because that's where it stopped at and then it shot up. And for when, that's the why. For when it comes back, we will look to see if it does exactly the same thing that it did last time, which was buying up. Now, bullish engulfing wise, right? Last time the market stops here and went up. Yes, it consolidated, but it did give us a 1 candle price action, meaning that it gave us a 1 bullish candle that engulfed the last bearish. So it took 1 bullish candle to engulf the last bearish candle to go up. Now, the second time it comes around, it took 2 bullish candles to engulf the last bearish. Okay, so you got another 3 candle, 2 candle price action, right? A 3 candle price action because it took 2 candles to engulf, right? Now, here's the next thing, right? So remember, we use the higher time frame, monthly, weekly, daily for the setup. Number 2, we go to the 4-hour. It will resemble the same setup itself because that's the time frame we're looking to execute. And then number 3 is the engulfing price action, right? So in the case of this, looking for the bullish engulfing. And that's one of the 5 to 6 variation that I cover on the ultimate price action available to you on Amazon. Now, it took 2 bullish candles to engulf the last selling candle. So right there, right? So this is, it engulfed it. So your entry is right there. Okay. That's where the entry is. Let me go ahead. Since I'm going to do some work with that, let me remove this temporarily. Okay. So, right. This is all bullish engulfing, right? To go up. So you enter here. That's your entry point. Now, your stop loss, again, goes at your last low. Remember, rule number 4. So 1, highest time frame for zone setups. 2, 4-hour. That's where the time frame we look into pull the trigger. 3, price action, the engulfing bar. 4, SL, your stop loss, risk management, right? So since it's a buying setup, we're using the last low for stop loss. Now, we look to the left to identify the last low, but we don't have a last low based on the left. But guess what? The last selling candle the market gave us had offered us an extended wick. So it created a long wick. So when you pull the trigger, right, your stop loss is gonna go at that low because this is the last low the market gives us. Okay, because to the left we don't have a previous structure low, right? So it comes in different variation, right? Just like the setup itself, the stop loss come in different variation. As long as you understand when, where, and why, you should be fine. Remember the word I'm using, understand, not know. When you understand, you just act, right? Read and react. So you would pull the trigger at your bullish engulfing, and you put your stop loss at the last low. Now, me personally, I like to place it at least 5 pips past the wick. Okay, but you should be just fine for the most part because you are acting in your best interest. You are simply doing what the market is giving you, and it's based off the past. That's pretty much technical analysis, right? Based on what it did in the past, you just being one with the market. Okay, and then of course you target high for TP. All right, so that's a different variation of zone placement and how to identify them. Again, not all of them is going to have an extended wick where you could use a rectangle property or 2 horizontal line to identify the zone within itself. Okay. Now, a different variation. Okay. Now I'm going to fill these in. I left it in there with the candles because that way you could see how it would look like. Right. So you do have an downtrend transition into an uptrend, right? We could play with this a little bit, do a little bit of work. All right. So, market was selling, giving you lower lows and lower highs. You see that? A trend up, right? Ranging up in a way. And then that's the retest point to give us our PA, to be more specific, a selling PA. So bearish engulfing price action. Okay. Let's just put PA. Okay. Bearish engulfing. Boom. Right. And then this retest point range. What I mean by that is it's just bounce within itself. That's still a form of retest. It just did not go all the way up, right? It went up. It just ranged within it. Now, remember, it's a selling trend. So we want to sell with the market, right? So just like here, we look for a PA or selling price action so it to fall. And then it came back, that it sold and went back to give you a clean retest of that point. Now, it fell down in breaks. So this was the last, the yellow candle was the last selling candle. Now, what you would do is, okay, you put the line chart on, it will show you exactly here. That's where the market stopped at. So you will generate your zone like so, okay? And then when you put it back on, you will notice the wick. So with the wick, that will be the zone within itself, right? Now you see when the market, after the market give you a lower low. So let's just mark this real quick, right? These are lower lows and lower high. So after each lower low, the market will give you a low high in a selling market or a downtrend. Okay. You look to take your trade at the lower high. So you sell at lower high. Okay. Okay. Boom. Like so, right? Now, market give us a lower low. It went up, low high, and then it give us a equal, excuse me, a equal double bottom, right? Where the wick did fall within the zone, just like so, right here. And then to go up. Now, I didn't put the price action in there. I just show you the last bullish candle it gives us. We can go ahead and generate a bullish engulfing. It would be one of those price action where it took 2 bullish candles to engulf the last bearish candle, right? See that right there? So you would enter here, okay? Stop loss there. That's how it would look like. Now, since we covering, I left it blank, we're going to be covering the retest aspect, right? So we got an equal double bottom that shot up. Not when it shot up, it broke. Let me change the color. It broke the previous low high to give you a new high, which is higher than the previous high. That's just one of the first part of trend reversal. Now we wait for the market to come back to retest that same zone, the same structure point, that lower high. Of course, remember, it could always drop a bit lower. When market comes back to that point, we simply going to wait for a price action. So now, before I even continue, we're going to take a step back, right? This trend reversal or this setup itself is based off the higher time frame. Okay, I'm gonna repeat that. This setup itself is based off the higher time frame, the monthly, the weekly, or the daily. Okay, the break and retest itself is off the higher time frame. either the monthly, the weekly, or the daily. Now you just going to drop down to the H4, or also known as the 4-hour time frame, to execute, to pull the trigger. And then you will be waiting for a 4-hour engulfing bar. To be more specific, a 4-hour bullish engulfing. So I don't want you guys to lose track of this. If I'm saying I'm on the 4-hour, this is how it's looking like. But just remember, this setup itself is based off the highest time frame. So, meaning in the 4-hour, it will look close to the same, right? With a lot of infrastructure, meaning a lot of up downs, right? And then you get a double bottom, right? At the same zone, right? And then you get a break and retest to continue up, right? So you can see all of this right here, right? All of this will be that break and retest in the 4-hour, right? So you wait for the market to break this high here to give you a new higher high. Once it comes back down to that zone, it means nothing. Why? Because it's just a retest. Once market itself gives you that bullish engulfing, right? That tells you, hey, buyers have now taken over. How do we know? Well, because the bullish candle is now bigger than the last selling candle. It engulfed the last selling candle. So buyers have engulfed sellers. They have taken over, right? Then you will pull trigger, right? You'll pull the trigger like so. And then I look for the previous structure low. Now, when we're looking at structure low, the last lower low was right there, down here, right? So this is where all stop loss has to go, right? Now, if you choose to place it at the wick low, cool. Nothing wrong with that. If you study it and you back test it and you see it works, right? It doesn't really go back to hit it, by all means. But from what I understand and experience, even if you go back test it, when you put the stop loss at the previous low, previous line on high, the market does not get hit, right? Very little. Yeah, very little. There's literally like maybe a 2% or 1% chance that it will. And that would be with a stop hunt. Okay. With that being said, because what I mean by that is, let's just say you enter this for the buy, right? And then the next candle and turn around, give you a bearish engulfing, right? You could literally close that trade and wait for the next bullish engulfing to go up. So what I'm saying is you will be able to cut your losses short and then simply wait and read and react. It won't just go and hit it. Okay. So once the market give you that bullish engulfing, you pull the trigger, you place your stop loss at the previous low. Okay. Or below the wick, 5 to 10 pips below it for it to go up. And you can see that break and retest here. This will be equal highs because it didn't break. It just ranged. Okay. It just ranged. It was just at this point, it broke. And then when it comes back to this area, that's where you will look for your bullish PA to continue. Okay. So that right there is a break and retest. So I'm going to go over it one more time, right? So market was going down in a downtrend. So it was a bearish market in a downtrend. Okay. You know what? Let me rephrase that. I'm going to shrink this a little bit. No. Come on, buddy. Like so. All right. I can still keep it in there so you could see it still. Okay. So look, just so we understand what we just went over. Okay. We had a bearish market that was giving us lower lows and lower highs, right? And then eventually it gave us a double bottom like so, where the bottoms are equal. And then it bought up. Not only that it bought up, it broke the previous low high, right? So the previous high. And then it came back down, creating a higher high. See that? And then once it came back down to that same zone area, we look for PA. Once market give us our engulfing bar, the bullish engulfing, we pull the trigger and we look at the previous low, which is the lower low that was at the double bottom. We'll use that as our stop loss. Now, what I'm saying is if you get a bullish engulfing with an extended wick and you want to use the wick of it within here, by all means. Okay. But that's literally what we just went over. All right. The first setup was the double bottom. And then the second setup was the break and retest. That's like a second entry. Okay. So first entry, second entry, third entry will be here, then fourth, All right, I know this is not a video on entries, but that's how it would look like. Okay. So let's go ahead and get the